wants to work. Okay, I'm going to start sharing my screen, and then we will go ahead and get started. Oops. Yes, that is okay. Screen share. Screen number 2. As always, Allie, let me know everything look good on your end.
We are good.
Okay, cool. All right, this week we are here with Mastering Credit Reports, a comprehensive guide for professionals. Whether you're a professional or not, I know we have people that sometimes go to the professional version of our event or the version direct to consumer. It's all super helpful information. We will post the recordings of these events on YouTube and on Facebook. We're streaming there, so they're automatically going to be saved there as well. If you're interested in attending future events, we host them every single Thursday. Sometimes we have a ton of people. Sometimes it's a little bit more of an intimate event. And other than that, feel free to ask questions throughout. You can either unmute yourself, use the chat. You can use the chat in the Facebook Live as well, or the YouTube Live if you're not here within the Zoom meeting. Am I forgetting anything, Allie?
No, hon, I think you are good to go.
Okay. Why don't you just dive into introducing yourself first, and then I will go next.
All right, I'm Alicia Alt. I regularly go by Allie, so I might say myself as my name is Alicia, and sometimes I say Allie, so I'm not trying to confuse you. I'm just confused myself. But I am a credit expert in the industry. I've been doing this for a little over 20 years now. August will be 21. Been in the lending space, obviously credit repair space, real estate space, you name it, in this financial industry sector. I have done it pretty much, except for the route that Ivory will tell you about. But Ivory and I together have created a software called Credit Score Pro, where we have a passion of helping credit for people at all levels, no matter where you're at, to give you the ability to improve your financial and credit life and ultimately your wealth. So I'll hand this back over to Ivory so she can introduce herself.
I couldn't have said it any better myself, as far as explaining what we're here doing together. So my name is Ivory Becker, 15. I don't know. I never update the numbers for this. We're now in 2024, so you might be at 21 and I might be at 16 years, but hey, it's what it is. Very similar background to Allie, just kind of a different side of the industry. So I've been in the default space since 2008. So dealing with anything credit and debt related on the delinquency side. We came across each other and we have the same passion and compatible personalities. And that's where we came into play to create our software. We'll talk a little bit about that software, how it can help you at the end, but we aim to spread awareness on credit, how credit works, and overall financial literacy, both for professionals and for consumers. So if you are in the banking industry, if you are in the lending industry, even though you are expected to understand credit, there's a lack of training. I've yet to come across a professional who was given any sort of formal training on credit, yet consumers come to you as that expert. So we aim to bridge that gap for everyone who attends these lives. So exactly what I was just mentioning. There's a lack of training on credit and financial services, but you are supposed to be the expert. And that's the major problem, because what do you do if you don't know the answer? It's a very uncomfortable position to be in because you feel like you should have the answers and you should be able to advise your clients or those leads, those prospects that are coming to you and wanting answers to their questions. And oftentimes they're going to be coming to you with things they saw on social media, especially nowadays, where we're very much inundated with people who portray themselves as experts and may not even intentionally be there to mislead people, but are unintentionally misleading people. So we want to dispel some of those myths. Now, before we dive into all of that, let's take a look at what's changed in financial services since 2020 / 2022. So And we'll compare that to 2023, 2024 here in a moment. We're going to really focus on the lending space, looking at the mortgage industry. If you watch the news, if you're on the internet at all, you're probably seeing a lot of headlines about mortgage rates, about everything lending based, right? So we like to focus on that as well. So credit's the leading factor in preventing mortgage qualifications. So if we have about roughly 69,000 people inquiring about getting a mortgage, not necessarily applying, but inquiring to a mortgage lender, only about 24,000 close, about 3 in 10 or 35% of those inquiries are closing. Now, as a reminder, that's 2020 to 2022 timeframe. So that's what the market looked like then. And the leading denial reason was credit history and debt to income ratio. Those two things tend to go hand in hand. If you have a lower credit score, you're paying more for your debt. That means you're going to have a higher debt to income ratio. And if we think about higher mortgage rates now, and if we think about those home prices still remaining quite high, we're seeing an even more of a compression or an inability to qualify for that standard mortgage. And we'll look at what those numbers really look like here for 2023 and 2024. So consumer behavior is starting to change. Those who had that great mortgage are staying put, right? Why would you move if you have a 3%, 4% mortgage? I looked at rates today and they were just over 7%. That's a big change. Younger borrowers are also looking very different than prior generations. There's some lingering debt, credit issues stemming from hardships from COVID. Even if you're past that hardship, you're seeing the effects of that hardship still following you. It's not something that's cured overnight. And everything is more expensive. I think we kind of already touched on that a bit. Debt to income ratios are increasing. There's a lot of expenses that are not included in debt to income ratios that are also higher. Think of things like car insurance rates are higher. I think what I saw this morning was about 20% increase nationally in car insurance rates. That's pretty high. You look at things like even your, oh, let me turn off the waiting room. There's people waiting and I'm not letting them in. Hold on. Let's turn that off. Okay.
Like you're a doctor's office holding everybody in the waiting room.
Yeah, you can't come in. Let's see, things like medical insurance rates are increasing, right? All these things are not necessarily included in that standard debt to income ratio. The obvious one would be groceries. We all, the joke is how much does a carton of eggs cost nowadays? I mean,
right.
You get
this is a real issue. I mean,
yeah, exactly.
Think about that for a second. If we're factoring mortgage loan approvals on DTI, but we're not factoring in all these higher expenses on everything else, we're missing the mark a lot, right?
Oh yeah.
Yeah.
Oh yeah. Yeah, absolutely. Now look at that last bullet point. The average base monthly payment for a mortgage. So that's not including taxes, insurance, PMI, any of that. That average base monthly mortgage payment for a new buyer now in 2024 compared to 2020 has increased by 78%.
Wow.
And we wonder why less people are able to buy homes right now when you combine all of that together.
Amazing.
Oh, I'm trying to move on and it's not happening.
Freezing.
There we go. But let's dive into that a little bit further. What else is going on? So if we look at credit card debt, we're seeing credit card debt increased in Q4, so end of 2024, by 4.7%, compared to that same balance in December of 2022. Active credit cards, so cards used in the last 3 months, increased as well. And then at the same time, what we're also seeing is less people paying those card balances off. So they're carrying those balances. We're no longer seeing a decrease in those balance in card balances stemming from COVID. So for a while we saw a peak where more people were living off their credit cards, utilizing their credit cards, and then we started to see it trend downward. Now we're starting to see the opposite happen again, where more people are using the cards and not paying them off. And at the same time, we're seeing an impact to credit scores. So we break down the credit scores into 4 different categories. We've got subprime between 3 to 600, near prime 601 to 660, prime credit scores 661 to 780, and then super prime, the red carpet credit scores, as Ali likes to call them, 781 to 850.
Hey, I'll give you red carpet credit at 760. So I'm a little bit nicer than that.
Okay, fair enough, fair enough. But the important thing to know about these different categories is we're seeing more of a divergence in these scores. And what I mean by that is those individuals in the prime tier are either shifting up or down. So we've got some shifting up to the super prime, and we've got many shifting down to the near prime, and many of the near prime shifting down to the subprime. So you're starting to see this widening gap happening between the credit score ranges, with everything trending more downward for the most part. And then at the same time, we're seeing less originations for all types of debt except auto loans. So auto loans is the only thing we're seeing a little bit of an upward trend in right now. So delinquencies. So let's tie it all together. So we know there's changes. We know everything's expensive. We are also seeing the changes in the credit scores likely coming from some of these delinquencies. It's expensive out there. Debt is expensive, food's expensive, everything's more expensive. For subprime, so this is going to be people that are in that 3 to 600 credit score range, more likely, I would say 4 to 600 when you see 300 scores. 20% or 21% are 30 days delinquent, at least 30 days delinquent on their auto loans. About 30% 30 days delinquent on their mortgages. Just over 15% are 30 days delinquent on their personal loans, and about 18% on credit cards. And if we break that down generationally, the vast majority of where we're seeing delinquencies is coming from the Gen Zs and the millennials. So the older you get, the less delinquency you're seeing. And some of that could be tied to the fact that when we're younger, we have to have more debt. We're starting out in the world, right? When you're older, you tend to have had a lot of things paid off at that point. You don't often use credit as much when you're older as well.
Right. You might have some assets to draw upon and thing. You
Oh,
may have bought that house a long time ago. That's was you bought it for 100,000. It's now worth 500,000, right? So yeah, there's
staying put too.
and you're staying put at 3%, right?
Yeah, I think when we're looking at the older generations, the average time frame they stay in a home is 10 years. And that's the average, right? Which means you got people staying longer or shorter. But it's pretty long compared to what you tend to see nowadays. Basically, to summarize it, Gen Z is twice as likely as their grandparents to be past due. So it sounds doom and gloom, but we go through cycles when it comes to the market. There are cycles where there's higher delinquencies and cycles where there's lower delinquencies. And obviously, I know it's vastly more complex than that, and I'm very much oversimplifying. But it's important to understand credit, how credit works, important to be able to answer these questions, especially if you're going to see most of the people buying right now being in that Gen Z, being in that millennial phase, whether it's getting a house, getting a car, whatever. They're in a time of multiple transitions as they age, which means they're going to need to rely on credit to leverage as they go through these different transitions in life. And then they're also going to have questions on credit, how credit works. And if their credit isn't in this super prime or prime tier, that means you're going to have to be that advisor, that advocate to help them understand how they can get their scores to a point where they can qualify for these different financing opportunities. Okay. So Ali, what is the importance of credit knowledge as a professional?
So for me as a professional, it's really important to have credit background knowledge because if you're a mortgage professional, real estate professional, you are known as the trusted advisor. Whether you like that title or not, that's going to be automatically given to you by your clients because that's how they feel about you if they hired you to do said job.
Mhm.
And one of the things that is important to them is understanding what's going on. What are you doing? What's your job? How are you doing it? How's my credit impact all of this? And if you're in that trusted advisor role and you don't know the answers to credit, that diminishes your ability to maintain that trusted advisor role. Whereas if you are able to give them the answers to those questions, and quite frankly, don't feel bad if you're in the industry and you can't answer these questions, because, Rex here on the call, he was in the industry and he never learned. This is not something that is taught in the industry, unfortunately, but it needs to be. And we need to know it, and we need to be able to answer those questions to consumers because they're not learning it anywhere either, right?
Mhm.
But if we're providing a service to them that is gated, I don't know if that's the right word I'm trying to use, but gated by their credit, then why can't they be given the answers to how to improve that so that they can have better lending decisions and terms and
Mhm.
interest rates and things like that, right? So I think it's super important that we have that credit knowledge for that. And of course, by having that credit knowledge, especially in our industry when so many people do not, in the professional industry, do not have that, and they're looked at as a trusted advisor, they lose and they diminish the trust of the consumer because they can't answer the questions. But think about if you are the professional who can answer the questions, and I don't mean you got the answers from social media. I mean true factual answers. You are going to be seen as the person, right, in the industry. And you need, more than anything today, professionals, we need to set ourselves way apart from the crowd
Mhm.
because there's a lot less business out there, but there's a lot of people in the business, right?
Right.
So how do you set yourself apart? You become truly, truly become the trusted advisor that they think you are.
Mhm.
Okay, that's my take. I'm off my
Love
pedestal.
it.
Yeah.
And I think another thing to consider too, and this doesn't mean you can't have good credit, but it's important to know that any delinquencies, any negative information is going to be on the credit report for the next 7 years. Over time, it becomes less impactful to the scores. But we are going to want to help to be able to advise consumers how to bridge the gap. If there is derogatory information, what can you do about it? How can you rebuild from it and put yourself in the best position possible? And I think Allie really already discussed that about as well as you possibly can. So, all right, I'm gonna let you cover this slide as well, Allie.
I think what we'll dive into is, we talked about we want to be that trusted advisor. Okay, so let's dive in some stuff so that we can get some of that knowledge back right now, today in this webinar, so that you can be that trusted advisor. Now, we're going to be very high level on this. I just want you to know that up front. Feel free to contact us if you want to deep dive into this, but we're going to high level it, but we're going to give you some really valuable takeaways because your consumers are probably going to high level their questions too, okay, because they don't know the intricacies to ask questions that aren't high level in most cases. Okay. So credit scores reports definition, it's a detailed summary of the individual's credit history. Most people who are watching this are going to be credit professionals. I think they can understand that definition. But we're compiling information and taking that information and creating a credit score based off of the information that's supplied by the credit bureaus, right? And so some of the contents of a credit report, obviously you got your personal information that has nothing to do with the credit score. It's just there. Credit accounts, current and closed, credit inquiries, hard and soft, public records. We do indicate on a credit report bankruptcies and if foreclosure notations are on the actual mortgage notation and collections, right? That's your body, your content of the credit report and the definition. So we can move on. You want to take on this part?
No, go for it.
You're pretty good at this stuff. So the role of the credit bureaus, right?
So are you.
You should say it better than me. I don't know what it is about it, but this is she likes to geek out on this part, guys. So that's why I say that. But the role of the credit bureau is obviously to collect the data, and they're going to take that data and they're going to use that to calculate the score, right? So they're getting the data from the creditors, debt collection companies, obviously applications when we're talking about credit inquiries and things like that. They're grabbing that data and supplying that to the credit report. And their job is to get accurate data from those sources to report that to the credit report.
So I think, oh, sorry.
Go ahead. No, you go ahead.
Oh, so I think what's important to understand here too is not every creditor reports to the credit bureaus, right? So a creditor does pay each bureau to report. This means you may see a creditor only reporting to one bureau or two, and sometimes with things like collection companies, often you may only see them on one bureau or two bureaus because it can be expensive. Those larger collection agencies typically are going to report to all three. Another outlier I would say would be some of the smaller credit unions don't report to the bureaus at all.
Or
So
might report to one or two. So
yeah. So for example, we had someone that was working with us a while back, and he had been at the same credit bureau for I think it was like 25 years, a very long time. Had no idea he didn't have a credit score. Had many accounts with them, car loan, couple credit cards, but none of it was reporting, and that was the only place he did business. So when he went to get a mortgage and he went outside of that credit union, he had no credit score at all. So just interesting, I suppose, more than anything. The other important thing to know is each bureau is its own private company. They are not necessarily working together, and they're really in competition with each other. And I think that most people don't realize that. And most people also think that they own that FICO credit score that's traditionally used in most lending. That score is on their server, but FICO has put that score on their server. They don't own it. There's an arm's length distance there specifically with the FICO credit score model. I think those are probably the top most important points that I would pay attention to today. Oh, what a great segue. What about what about the Vantage score? So in 2006, the Vantage score was created. And Vantage score was created because the bureaus don't own the FICO credit score. They don't like that. They want to compete with FICO. So the whole aim of their creation of that Vantage score is to essentially try to build something better. Create a little healthy competition. And ideally, what anyone is trying to do in this type of situation is take over, right? And basically push out that FICO credit score algorithm. Now, most clients, if they are using Credit Karma, let's just put it plainly, or some other free version of their credit score, maybe from their bank, but most often when you're getting a free credit score, it's typically going to be that Vantage score. What you'll see here on the screen is there are some differences in the weighting of the information, right? So I think it's quite obvious. We see utilization 20% versus 30%, payment history 40% versus 35%. Overall, it's looking at similar factors. Weightings are slightly different, and then the way it calculates that information or utilizes that information to generate the score is going to be different as well. But all in all, the whole point is the same. How can I, as a credit score, most accurately predict risk, right? So essentially saying my credit score algorithm is better at determining whether this consumer is going to be able to pay things on time or more likely to default or be delinquent on an account. So I think we all know higher the credit score, less risk. Lower the credit score, more risk that lender or that debtor is taking on, allowing that consumer to borrow money. Anything I missed there? So if we dive a little deeper into the FICO side of things, because for now, and this is changing, and we will do a webinar just on this change, probably, I don't know, in the next quarter, let's say, give us some leeway. For now, FICO is the main player in the game. As that shifts, we will dive more into that Vantage score, what that Vantage score looks like, how it's used. But at this point in time, I'm going to say loosely, it's about 95% of lending decisions, although we're seeing Vantage start to take a little bit more traction. So I may be off on that number at this point. So about 95% are made using the FICO credit score algorithms. Now, when you look at the FICO credit score, you're going to notice on this screen, there are many different versions. We've got version 2 all the way here to version 9. There's even version 10 and 10T, which aren't listed here. The important thing I guess the best way to look at this is if you have iPhone, I'm an Android person, but those of you out there with iPhones, if you have an iPhone, you start off with the first version And the whole point of every new version is to make a better model, right? It's a better phone than the last phone. That's the same thing with these versions of the credit score. The whole point was to improve upon that algorithm and become a better predictor of what consumers are going to do and to adjust the algorithm based on changes in consumer behavior over time. So I think that's the best way to think about this. So when your client, if you are a mortgage lender, let's say your client's going to Experian.com and they're like, yeah, I'm getting my FICO score. That free credit score on Experian.com is FICO 8. So if you see on the screen version used in mortgage lending for Experian's version 2, it's not going to be the same credit score. Similarly with other industries as well. It's not going to be the exact same credit score. Anything you would like to point out about the versions of FICO?
Well, no, there was something that I wanted to say when you were talking earlier, and I think I've lost my point on it. But I guess the biggest point is, you talked about Vantage and FICO and how, you said 95%. It's probably even less than that. That's actually,
Yeah.
yeah, I think FICO's really got control in this game right now. And in about 2 years, we'll see some changes, I think, is when that's going to happen. But the biggest point that I like to show on this, and when we're talking about professionals, because most of our professionals that I'll be watching this are in the mortgage lending industry or real estate, is that when we're looking at a credit report, we're looking at FICO 254, right? Across this bottom area right here. And it works very differently than FICO 8, which is what the model that most other lenders are looking at, right? And so when you get that call on the phone, hey, I went to go buy a car and they told me it's this score, and you're telling me that it's this score, and you're lying. You really need to know the answer to that is that no, we have different versions, right? And I think that's the biggest thing. And even when they talk about, what their score is on Credit Karma, that's a very different model. So in summary, I like to just summarize the mortgage credit report. I tell all my clients it's the mean one. It makes it easy for them to understand. It's the mean one. It's the one, they're all right, depending on what you're trying to get in life. They're all right, because you'll get a lot of the questions that I get is, well, what is my true credit score? Well, all of them is your true credit score. You just have to pick a goal and then determine which one's going to work for you. But so it's right, but it's the mean one. I just thought I'd say that.
Yeah, absolutely. Absolutely. Great and important things to add. Okay, so let's dive into understanding the credit scores. So the next few sections, what we're going to do is really hone in and focus in on these categories and how they function when it comes to the interpretation of the credit score. So we're going to start off with payment history. Payment history is the biggest overall factor contributing to the credit scores. I think this is kind of the one that everyone's most comfortable with. I think the obvious is good payment history helps, bad payment history hurts. An important thing to understand, and we get this confusion often, is, well, the account is closed now. What's that late mark matter? Unfortunately, when the account is closed, even if the account is closed, the late mark is still going to adversely impact your credit score. Outside of that, for someone who's trying to rebuild or reestablish credit, often I think they forget that the payment history section can be a benefit. You don't want to be afraid of credit and just not use it now, because you've gone through a blemish, or maybe even more than a blemish, a blunder, a credit blunder. Reestablishing positive credit and showing positive history after a period of delinquency will cause your score to go up. If you are, for example, let's say you got a 30-day late mark, a 60-day late mark, now a 90-day late mark, you'll see a little bump up in your score once you pay that next payment on time, because now you're showing you're coming out of that hardship, if you will. But the more good payment history, the better. I think that's pretty self-explanatory. I'm sure there's more I could touch on with this category, and you can fill in the blanks for me, Allie.
I just wanted to say, it's what you just said is really important right now with FICO, the FICO versions that we're using right now, right? If you had a blemish, you went 30, 60, 90 days. Once you start paying it on time, you start to rebuild that credit score back up, right? It could take some time, but you're going to do it. Not that we're there yet, but just start getting in the habit that that's the way that you work. Because when we bump into FICO 10T, which is on the horizon, that's going to be a real thing. They're
Mhm.
looking at trended data. What are you doing today? And they're the score is very heavy weighted on today. So when you go 30 days late, but then you have a trend and now you're paying it on time, well, that's your new trend, right?
Mhm.
And so you're going to establish those credit scores back up positive, more positive faster because of that trending data. So just get into the habit now that, you know, have a blender, fine, go fix it as fast as you possibly can, right? Make
Right.
that part of your regimen.
Yeah, and I think, I guess to add what you're saying, the whole point of the algorithm is trying to predict what you're going to be doing. So it can only use if you're showing, hey, now I'm paying things on time now, then the algorithm is going to point to, okay, they're more likely to keep paying things on time now. If I'm only showing delinquent information and I'm not adding any new positive payments, the algorithm is going to say they're most likely going to stay past due, right? There's nothing else to go off of. So, amounts owed. Said differently, utilization. So utilization ratio, Allie, what is this primarily focusing on versus, I guess what I would say is like one of the more common myths about utilization.
So utilization is commonly focused on your credit card utilization, right? So how much of the credit card are you using? It doesn't really factor in like, you know, you could have, I went out and got a loan and I have a $5,000 loan and I owe $5,000. That's not really a factor of this credit utilization that we're specifically talking about here. But loans can have a factor in this credit utilization. The most widely seen in that is student loans.
Mm-hmm.
So I can have a client that has beautiful credit, but they have all these student loans and they owe more on the student loans than their original loan amount. So maybe they were in school and they had it deferred and it was unsubsidized loan. It's gaining interest that whole time, except in COVID time. And it's getting interest that whole time. So it's growing. And unbeknownst to the consumer, it's negatively impacting the score. And people get surprised. They're like, I've never missed a payment. I was deferred. Like, why is this hurting me? It's because you owe more than the loan that you got. So remember that the credit score model is predicting your financial stability, right? Whether or not you have good credibility to pay a debt, right?
Mm-hmm.
So if you're not paying it, now you owe more than you received, what common sense will tell you that it's probably going to drop your score, right?
Mm-hmm.
And so credit student loans tend to be a really major problem in this category, but the majority of the problem that we see is credit card utilization.
So what's the best way for someone to approach paying off their credit cards? They have all their cards maxed out, let's say. Let's say they have 5 credit cards, all maxed out. We've got a range of credit card limits from 500,000, 500,000. Oh my God. $500.
Bankruptcy. I'm just kidding.
500,000 from $500 to $5,000.
I laughed about that, but I actually had a client that had $250,000 credit card debt.
Oh, that's
Yeah,
painful.
that hurt my soul seeing that. But
Um,
okay, so if I had said, say 5 credit cards, they're all maxed out.
mhm.
The way to approach that is not the Dave Ramsey way, which would say, hey, pay the one with the highest interest rate first, snowball it down. And, you know, when you get this one paid off, you pay the next one. That is not the right way to do it when we're talking about improving the credit score, which, and I'm going to tell you, Dave Ramsey's approach is just not the right way, period. Because if we're going to help our financial
Going
situation,
for jugular.
yeah, if we're going to help our financial situation, we have to do it in conjunction with helping improve the credit score. It's very important. They have to go hand in hand. You have to mesh those together if we really want to help somebody. But that's a whole nother webinar. But what you would do is, let's say you have one that's, you know, a $500 credit card. You have a 300. You have a 200. You have 1,000. You're going to work on the $200 one, the easiest one first. Get that one down to about 20%. That's the magic number, by the way. 20% of the credit limit. So now you want to get that balance down to 40. Once you get that balance down to 40, you don't pay it off. Don't worry about paying it off, because if you have that extra $40 to pay it off, roll that $40 into the next easiest one. And you continue that until you go down. Now, if you want to go back up at the top and pay them all off, please do. Like, I would love you to do that. Get out of debt, right? But take it in those strides first, the easiest to the hardest. You're going to see your credit score improve faster that way. And then you can utilize all kinds of other resources that I would love to teach you on how to get out of debt from that point. But that's again another webinar. But just go the easiest to hardest.
Now I say pay them off, so we have a slightly different take on that, but you know, same premise.
She took a
Always,
bankruptcy course.
yeah, always start with the lowest. Because if we look at utilization, if you want to go into that a little bit too, Allie, if you don't mind, how is that algorithm looking at utilization between the cards versus the report as a whole?
So overall, it's looking at how much utilization overall,
Mhm.
but also individually cards, right? And that's why I tell people don't worry about paying that first card off. Use that extra money to spin it down to the next one because the algorithm is looking at line by line that your utilization is low and then overall.
Yeah, so it's two separate calculations, both help you, right? So it's so much easier to take care of that little one first and get that bump from that part of the calculation that looks at individual cards. So, yeah. Now this is a good segue. We're gonna jump into length of credit history, but Allie, why when I pay my car loan off, because I had a big loan amount, it makes sense for me to get rid of a whole bunch of debt. That's gonna help my credit score, right? So I pay my car loan off. That should help my utilization and bump my score up because I owe less, right?
No, unfortunately, and this is a widespread myth, and I'm not sure where it came from, to be honest with you. I think it's been from, what's financially healthy versus credit scores, and then they kind of threw them all together like they worked the same
Oh,
way.
next
Don't.
slide.
So, if you were to have a car loan and you were to pay it off, you might actually see a drop in your credit score. It definitely didn't help your utilization because it's a closed account. So now, quite frankly, there's no utilization, right? Just like a credit card, if it's closed, there's no credit limit anymore, right? So that it is a factor for your utilization. Same thing with the auto loan. But the worst thing about an auto loan that I see when people pay it off, and by the way, I'll go into this. I'm not suggesting that you don't pay off your auto loan. I'm suggesting a time to do it, right time, the wrong time to do it.
Time it
But
right.
if I have extra money and I'm going to choose between paying off my credit card debt and paying my auto loan, 100% of the time I'm going to pay off the credit card debt. Okay, let's just put it that way. But if my history of credit is my longest history of credit falls on my auto loan, which tends to be for a lot of people, and now I pay it off, I just diminished my age of credit, my length of credit history. So I dropped my credit score, right?
And
Financially, it might have been a good decision, but again, like I said, if you have credit card debt or other debt that has a higher interest rate than the auto, then it never was a financially good decision either, right? But if you're not in that situation, you don't have debt and you're thinking, oh, I have this extra money to pay off my car, that's fine. But understand we want to make sure you built that history on the credit cards, number one. And number two, what is your next goal? Is your next goal to buy a house in the next 2 months? If it is, maybe you don't pay the car loan off yet. Buy the house first. So you have to, anytime you're doing anything with your credit, you really want to know what is the next goal. Okay.
absolutely. And I'm going to dive into that a little bit more just to explain even further what you're saying, unless hopefully I didn't overlook it. But one of the reasons that Allie is saying that is because even if that account was positive, let's say you had that car loan for 7 years, I don't know. Even if that account was positive that whole 7 years, the second you close the account, it's not factored into the length of credit history, even though that account's going to be on your credit report for several more, many more years.
10 more years.
Yep, exactly. 10 more years. I think we had that on a slide in the beginning. Maybe we didn't. I don't know. But only those open and active, keyword active accounts are impacting your credit score. When I say also keyword active, that means it doesn't matter if you had that Kohl's credit card you got 15 years ago that you haven't used in 8 months. That's not helping your score anymore. Why? Because it's not active. So I know this is one of Allie's favorite things to talk about, but Allie, how often do I need to be using my credit cards, even if I hate credit cards a ton?
Well, there's a hack that I like to tell people to do, but
Go into it. Go into that hack.
well, in general, you want to use it every 3 to 4 months, right?
Mhm.
It does two things for you. One, it keeps that activity on the credit report, so you benefit with the credit score, right? Also, it helps to keep that card open so they don't close it on you. Because the worst thing you can do is
Yeah.
have, a 10-year long credit card and then you didn't use it and they closed it on you, which is real stuff. I see it all the time. But the hack that I like to tell people to do, especially if you don't like credit cards, if you're working with me, I'm going to have you get 3 credit cards. There's 3 specific credit cards I'm going to have you get, but you're going to get 3, whether you like it or not. Okay, that's my rule if you're working with me as a coach. But we're going to use it in a specific way. So it might be that because you might not like them, first of all. You might have a Netflix account. You're paying the Netflix anyway on your debit card through your ACH, whatever you're doing. But instead, you're going to add that to your credit card and have your bank pay your credit card off. So it's hands off. You don't have to think about it. You haven't done anything different in your life. You just paid it differently to improve your credit situation. And so that's what I usually do with the 3 credit cards that I have my clients get. We hack it. We have something automated. It's small. We pay it off through their bank account and we can take the cards and put them away. We don't have to use them at that point. But don't, please, please, please don't think that you're building credit by going out and getting the credit card and then saying, I don't like credit cards and throwing it away. That's never going to help you.
So those credit cards allow you to have that length of credit history because other accounts close, right? But the credit cards, they don't close. They're open and active accounts. You get the benefit of added payment history when you barely even have to use the account, and you get the age from it. And then at the same time, Allie's mentioning 3 accounts. Well, the credit score algorithm, to get to that eventual perfect credit score, it wants to see at least 3 credit cards, okay? And so that's why she's saying you have to have 3 credit cards. Our goal with anyone we work with, whether you're using our software or working with us individually, is to get you to that eventual perfect credit score. Okay, that's the path you want to go down. So get used to it. You have to have credit cards. You'll work your way to the ones that you like. You'll develop and build those habits. We understand that it takes time, and it takes time to build that comfort. What else? There was something else I wanted to say, but I lost it too, and that's okay. So we'll come back to it if I remember, but I guess that does segue into credit mix. Credit mix is important as well. So this is really just saying, to put it really plainly, can you responsibly manage different types of debt, right? So can I pay my credit cards on time? Do I use them responsibly? Can I also pay my auto loans responsibly? So it really, this is just saying it doesn't matter the kind of debt that you take out, you're going to be responsible. Oh, I zoomed in on myself. Sorry, guys. I don't know how to fix that. So
You're fine.
we're going to be really zoomed in. The other thing to consider with credit mix is it does look at things like a mortgage as a responsible type of debt. So you do get an additional benefit for having a mortgage. They're harder to qualify for. You have to be a more responsible borrower to get a mortgage as well. So remember, the credit score algorithm is very much focused on debt. It's meant to determine how much risk it is for you to borrow from a lender. So it doesn't care about your income. If you notice, we haven't talked about income once. It doesn't care about your age. That has no factor. So if you are, 20 years old or in your 20s, let's say, and your parents set you up with an account when you were 16 that you're authorized on, etc., you could start off with an extremely high credit score. So credit has the opportunity to give you leverage. It allows you to change your entire financial picture, regardless of where you come from, regardless of where you are right now. It gives you that potential to have a really strong future. So new credit, also known as new credit and inquiries, I'd like to add in there. This is really just focused on, again, if we take it from a risk perspective, are you going crazy and applying for a whole bunch of different debt? If you are, that's a signal that you may be going through some sort of a financial hardship and you need that debt to get you through the hardship. So this is really more like a flag that's being thrown up, like, hey, maybe some risk here. We need to pay attention. Anything you want to add on that section, Allie? I'm keeping it pretty high level.
High level.
Okay.
Good stuff.
Okay, so in summary, if we were just to consolidate that long-winded explanation into a few topics, we would say make sure you have an open and active credit card that's been used in at least the last 6 months, ideally 3 cards, to be very clear. Don't pay off loans prior or during the application process. If you're getting a mortgage, we would suggest paying it as part of the closing, especially if there's a debt to income concern with having that debt open, right? Now, you don't have to consider the debt to income ratio because it'll be paid off at closing and your score is not going to be adversely impacted. If there's limited credit profiles for now, you can use authorized user accounts to create longevity. There's a lot of other tools available, which is that next bullet point, utilizing credit building tools. Get things on your report like your rental history. You can self-report things. There are a lot of different resources out there. If you go to creditscorepro.ai, their credit building section does list all of those resources available. And then lastly, another quick hit tip is resolve errors or derogatory accounts on the credit report. These things can impact the scores. Remember, those 3 credit bureaus are independent companies. So as that top bullet point points out, there can be mismatching information on the credit report. There can be incorrect information on the report, and there can be obsolete information on the credit report, which essentially means it should no longer show up. It's obsolete. It's not valid anymore. It might be too old. I know what I was going to mention. If we go back to accounts owed, charged off accounts. I don't think we've touched much on charged off credit cards on the utilization section. What happens if all of my credit cards are maxed out and I have charged off with balances? What's that do to my scores?
You're asking me? So you
Yeah,
have
yeah.
charged off credit cards, you have balances, or you can say it differently even, and this I see a lot, you have credit cards with balances, but the credit cards are closed.
Oh,
right?
sure. Oh,
Yeah.
that's another great example.
So what happens is you no longer have the credit limit on, but you have a balance. So it's affecting that credit utilization.
Exactly. And I think that's something that's often overlooked. And I know both of us have had people that have come to us before and they're like, I don't understand why my score is so adversely impacted. All I have is, one open credit card, $200 limit, $200 balance. Like, I mean, I can pay that off really quick, but what's going on here? Well, it's all those charge off accounts. The last thing I think we probably missed touching on here too is collection accounts. What happens when I pay a collection account? Is that impacting my utilization? Does that help my payment history on my credit score? We'll be high level. I guess I'm asking you, Allie. This is interview style today.
Okay, Ivory, you want to put me in here? Okay, so collections.
The answers.
Collections, it really, there's a lot to look at as a credit professional myself of how collections are going to adversely affect your credit, whether or not paying them is a good decision or not for your credit. There are a lot of factors, and they happen to do with a lot of the dates on the credit file. And to be quite frank with you, a lot of professionals don't even know where those dates are or what they mean. Okay. But those are very important, especially when we're looking at the old FICO model. When we look at the newer models, those dates don't matter as much, and that's a whole nother webinar. But on these old FICO models, the dates have a big impact. So if I have a collection, for instance, that hasn't updated in the last 2 years and I pay it, I will drop the credit score. Okay. If though that same collection has been updating every month for the last 2 years and I pay it, I would actually improve the credit score. And then there are also collections that have internal policies that if you pay it, settle it, pay it, however you get it done, it will be completely removed from your credit report like it never happened, right?
Pay for delete, right?
They delete. Medical collections do that now. If you pay or settle it, somehow gets to 0, it will be removed from your credit report. So there's some advantages to paying off collections, and then sometimes there's not. That's, again, we're high leveling this, but there's a lot of details in that to determine what's best practice.
Yeah, I just thought it'd be fun to touch on it because especially if we're starting to see more dependencies, and more default coming into play. The best thing to say is it can get complicated, so don't rush to tell your client, your consumer, whatever, don't rush to making a decision.
Yeah.
Let's pause, let's assess, and we're going to show you exactly how you can.
Really big on, let's make sure that we're challenging any collections and negative information before we act anyway. So that gives you time to digest that, because it does need to be a validated debt before paying.
Exactly.
I can't tell you how many people pay a debt and then it's not validated and they never had to pay it. So they're spending money that they didn't need to pay. I mean,
Mhm.
it really needs to be validated, or they get the phone call on their way to work that says, hey, if you don't pay me $600 right now, there's going to be a officer at your place of work and they're
They're
going to arrest you.
scams.
You know, and they're scams, right? And they're not even true companies collecting. You might have had that debt, but they stole the information. So it's not good in any way, shape, or form to just decide, hey, it's on my credit report, so I'm going to pay it. That's not the way to do your credit.
No, not at all. And a little bit of a segue, but if you are a professional in the lending space and you're getting those credit reports from your vendor, make sure you're paying attention to this section. It's telling you what's impacting the credit scores. This can be like your key or your legend. Like if it's like it's your map, it's your roadmap to tell you what's going on with that credit that's adversely impacting the scores and gives you some guidance, especially if you're uncomfortable with reading credit reports. You can, don't read it verbatim, but you can walk your client through a conversation, and this is a great starting point, and it will also get you comfortable. You can read, okay, length of time accounts have been established. Now you can look through the credit report. You can say, oh, okay, I see. That makes sense. All these accounts are less than a year old. Okay, they don't have a lot of history. So how can we add history to the report? How can we add longevity? Number two, delinquencies. Well, I think that's a pretty obvious one. There's negative information, it's bringing scores down. We know that's biggest factor is payment history. Too many accounts with balances. Okay, so this person probably owes a lot on credit cards. We know they're going to need to address that. And now you know the path. All right, they're going to start with the lowest credit limit first, right? Number of accounts with delinquency. Obviously, that ties into delinquency. So we got a lot of accounts with delinquencies. And then lastly, too many inquiries. That one I don't ever pay too much attention to. I don't know if you do, Allie, but there's more important
Depends
things
on
to
the
look
call.
at.
I mean, if it's a mortgage situation, no, not so
Yeah.
much, because you could have too many inquiries on there, but they were all from an auto lender and they were
Right.
So, but
Yeah.
if you're, not that we're talking about this, but we might have professionals on here with business credit, that would be important.
That would factor. Yeah.
That would be very important. Keep in mind though, you can have a perfect credit score and still you will have at least 4 reason codes on this screen. So it's not fail proof, right? Because, if
Right.
you were to line up, I do honestly have the perfect credit score. I do walk the talk that I talk, but you will see 4 factors and they really don't make sense to my credit, right? It wouldn't even, they're just there for show. I don't know what to tell you, but
I'm being honest. If their clients come in with perfect credit, they're probably not even looking at the report. They're moving on.
I was gonna say that you don't care, right? But I just thought I'd mention that,
Yeah.
that they do have to put 4 reasons on there. So I would suggest that you look through the reasons and then kind of focus on what reasons on that. We look at the 5 factors of credit. We had the percentages of what makes up the credit score. So we look at those 4 reasons or 5 reasons. If they give us 5, which ones of those are going to have the biggest impact to the credit score that we can possibly make a connection with and help improve the credit score.
Yeah. I think I just over this. We already talked about what these perfect traits are of the credit score. Okay. What about clients' accounts whose scores don't quite cut it even with your advice? So a little bit of a transition here. We've talked about what those reports look like, how to understand credit scores, but we are in that time of transition when it comes to the type of client you're going to see. So you really can't ignore, you need to help people. It's your duty. Like really, to just put it plainly, if somebody is coming to you and they have a goal of buying a house, getting a business loan, I mean, the entire point of what they're trying to do is improve their lives. They're seeking leverage to propel themselves forward, and you are the key to getting towards their goal. And you want to have the solutions to help them get there, even if it's not right now. It's not never, it's just not right now. And by being able to be that resource, and I think Allie really already talked about this, You're going to be able to not just have a client for a single transaction, but have a client who, hopefully for life, but someone who's going to refer to you, who's going to trust you. You're going to be able to do so much more for them. And I think what a lot of people are wishing they would have done, a year ago is building their pipeline for later instead of being so hyper focused on the here and now because there was so much business coming to them in that moment. Those professionals who still work with us now or who did work with us even during that time frame where things were crazy, things have slowed down, but they're still getting business where some others aren't doing any business at all. And it's because they had that focus on building their pipeline, nurturing these relationships, and being that actual advisor rather than that transactor. So I don't know if I missed anything you want to point out.
No, I mean, the loan officers out there who built their business around the excellent credit scores didn't want to give time to anyone who had subpar credit or didn't have great, super prime credit scores, right? They want to do the business with the people who that it was an easy transaction. They're not having that business today. That business is not there. So they've kind of shot themselves in the foot, to be honest with you. And so, we are looking at a different market. We are looking at a different segment of individuals, and we have to, if you haven't already changed, and hopefully you caught that a long time ago and decided that you were going to go that route, but this is where it's at now. We need to be the trusted advisor. We need to be there for all people and have a process for all people. Do we want to do loans for the people who have really great high credit scores and it's an easy, fun process? Absolutely. But we should have a process for every person that comes to us. We should truly be the trusted advisor in this industry. And I cannot say that enough. Every person who comes to us is a value to the world, right? That's a whole different subject, but we need to value people, period. And just because you have great credit doesn't mean the person who has bad credit, it has some less value than another. They don't. So let's have a process for all people. And that's the passion that I have. And that kind of shines through the product that we have created, which is Credit Score Pro. It's really meeting people where they're at, whether you have really good credit and we can make it even better, or help you reach a goal. Or if you have credit that needs help, we can make it better, but we're going to meet you where you're at, regardless of what that is. And we're going to be your trusted advisor, regardless of where you're at. And we do all that through AI and through a software that we created. And the reason we do it that way is because by doing that, we can have a very low cost to the consumer, which actually we'll talk about here in a second. But
You can talk about it now.
Okay, it's free.
We're gonna show, yeah, we'll show the software in a moment. So I think go for it. Explaining.
Yeah, so we're able to provide AI software to everybody for free. So if you are a professional in the industry and you have clients that need help, this should be your system. You shouldn't just let them go. You should say, hey, I have a process for you that's going to help you get to their goal. Not only do you have a process that's free and affordable, but it's efficient, effective, it's fast, it works. So you're giving them something, you're going to look like a hero, quite frankly. And then now they're going to send everybody they know to you, whether that's a person that needs additional credit help and you're going to send them through this system again, or they have great credit and they're ready to buy especially when times change. But you're truly going to be seen as that advisor. So it is powered by AI that allows us to offer the software for free. Where are we at now? How's it differ? Okay. This is great for those in the mortgage industry, real estate professionals. You have Credit Score Pro, and then a lot of you are used to like Credit Expert, Wayfinder, right? What if simulators that you see on different free sites, things like that. Credit Score Pro has an action plan that's a tailored action plan for the individual. So if you went into Credit Score Pro and you said, hey, my goal is to buy a house, it's going to read that credit report and it's going to produce an action plan for you specifically tailored to you wanting to buy a house. Okay. And
this algorithm, right?
That algorithm. Yes, absolutely. Whereas Wayfinder, Credit Expert, they don't have that information to be able to produce an action plan that really does tell the person exactly what they need to do to improve their credit score. So this is like if you take Wayfinder or Credit Expert and you put it on steroids, okay? That's what you're going to get with Credit Score Pro's algorithms. But it's also and I'm gonna just talk very briefly, very high level, okay? But I look at Wayfinder and credit expert reports all the time,
Oh.
and they are wrong all the time. And I mean wrong in a way that it could actually hurt your consumer. So if you are a credit expert and you're used to, hey, I'm gonna run a Wayfinder report, and I think you guys pay $16 for that report too. You're gonna run a Wayfinder report for your client, and you're just gonna email it to them. Please do your due diligence before emailing it to them, if that's your practice, to make sure that the recommendations actually are good recommendations.
Mhm.
I just had a woman who got one email to her from her loan officer, who happens to be a friend of mine, so you know I talked to him. But she had a student loan on her credit report. Her minimum payment for her student loan that was due was $248. And I might say these numbers wrong. I'm just going to give you a general idea of what this said. So let's say it's $248 that she had to pay. That's her monthly obligated payment.
Mhm.
Wayfinder said, instead of making your $248 payment, make a $148 payment. Had she followed that recommendation, she'd be 30 days late on her student loan. What would that do to her credit? It would hurt her credit.
Drop her
I'm
scores.
still trying to find out where could have, in any way, shape, or form, thought that it could benefit her credit there. I haven't figured that out. I'm trying to crack their algorithm and see why they came up with that number. But do yourself a favor if you're a professional. Don't just hand out that without doing your own homework. But Credit Score Pro doesn't do that. We're not a simulator. We're not making up stuff. And I don't, like I said, I don't even know where that came from. Couldn't tell you how that even came about to give an action step like that for them. But this is really looking at the FICO 542, right? And what do we need to do to improve that algorithm?
For that goal, right?
That goal, right? So we have in Credit Score Pro many other goals. Okay, I'm just giving you an example because I know that the masses that we're talking to are going to be in that mortgage space. But there are several different goals inside of Credit Score Pro that a consumer can choose from. And they're going to get, based on that goal, what's the action steps for them to take, if that makes sense. But I just wanted to kind of harp on the difference between Credit Expert Wayfinder and what we do, because there is a difference. And it's just a much more powerful process. And guys, you're not going to have to pay $16 for it, because remember, Credit Score Pro is free. There is a catch. We do have to have a credit report to read. I mean, that's obvious. And so we had to partner with a credit monitoring system so that we have a report to read. We did partner with a company called Smart Credit, which is an amazing company who has a lot of amazing features with inside their product by itself. But when you combine it with Credit Score Pro, you have a powerhouse. Like, there's nothing else you need in the credit space. And you're going to pay $34.95 for the credit monitoring. So you get the credit monitoring.
$39.99.
I'm sorry, $39.99. I always get that wrong. $39.99 for Credit Score Pro, and you're just going to link it. So you sign up for Credit Score Pro, and then it's going to say link your credit report. That's when you're going to sign up for Smart Credit for their credit monitoring, so it can connect to Credit Score Pro and be able to use the resources. So it's, and that's, yeah, go ahead.
And then I'm going to show what it looks like here next, but we're 5 minutes over, so I'm going to do it really fast.
Fast.
Okay. So once you do exactly what Ali said, you sign up for Credit Score Pro, you link your credit report with Smart Credit, which is $39.99.
Thank you. I'll get it right one day.
Then you can access the software. And so we'll look at what that looks like. So the AI is automatically going to analyze the raw data credit file of your credit report. And we'll look at what that raw data looks like on the next slide. But essentially it's reading all the code on the back end. So on that right side of the screen, that's what the raw data looks like. That's what Ali spent years looking at and dissecting to help make this algorithm do what it does. So nobody wants to look at that. We don't want to look at that. But the AI can look at that in a matter of essentially seconds, actually. And from there, it's going to find errors and issues. So the system is automatically going to show you every negative account. Now, you can look at your whole report, right? As you see in that picture on the left, you can click all. But it's going to automatically highlight every negative account. We suggest that you click every negative account on your credit report. And then from there, the AI is going to automatically generate a dispute for you based on the dispute that makes the most sense, right? So after reading thousands and thousands of reports and sending thousands and thousands of disputes, because this is true machine learning, it learns what the bureaus do respond to, what they don't respond to, what works, what doesn't work, as well as, of course, understanding the laws and regulations with credit reporting and what a valid dispute is. And it's going to create that dispute for you. Now, the only time that we suggest changing this drop down that I'm pointing to here is if there's fraud. AI doesn't know if there's fraud. So if you were to click here, there's an option to say that the account was fraud. Now, you are only going to do that if it was fraud. If you are claiming fraud on something that was not fraud, you are breaking the law. I want to be very clear about that. There is a fad, there is a trend with people doing that. Do not be part of the trend. Okay? Bad trend. Don't do it. The AI is very successful, so you don't need to be doing things illegally. Anyway, off my soapbox. So after you agree to the dispute, and that's really the only thing you have to do is just you have to make sure you choose the accounts you want to dispute, and you have to agree to what the AI wants to dispute or make that change if it is fraud. From there, you're going to do that for each bureau. You're going to get an email with every dispute letter, one for Equifax, one for Experian, one for TransUnion. So you can print it and mail it off to the credit bureaus. You'll also see them in your portal in Credit Score Pro's website. You can download them there directly as well, but we like to make it easy on you, so you get an email. If you do not have access to a printer, you don't want to mail it, you do have the option to use our integration with maildash.io. I know Allie is sitting on her hands waiting for me to say that she thinks the most important thing you could do is print it and mail it yourself. The bureaus do look for disputes to be sent from you. Okay. So they're looking for it to be postmarked in your location, your city. You do get a better response rate if that's the case. Okay. So there are instructions on the top on exactly how to do that, what the bureaus prefer when you send the dispute. But if you want to make it as easy as possible, you can. And we did want to make this, capable for anyone to use. Not everyone has a printer, especially if you're only doing this on your phone. Some people don't have computers either. So that is the dispute side, right? How much easier could it be if you have negative information in your report? It's that easy. You just clicked 3 buttons, okay? And now all of a sudden the AI has created disputes and it's extremely good at it. What about everything else? Yeah, but wait, there's more. What about everything else that's impacting your score? I mean, that's the whole point of what we looked at, or your client's score in this case. There are several factors impacting credit, and we want to make sure, oh yeah, I got to go fast. We got to make sure that we're bridging that gap, right? So how do we optimize the good accounts? How do we get more points out of the good accounts? And how do we look at where you're not influencing that credit score algorithm? And what are your goals, right? Are we using the right algorithm? Well, that's what the action plan is for. So you pick your goal, and picking the goal determines what credit score algorithm makes the most sense, right? Obviously, as Allie had mentioned, if your goal is to buy a home, it's going to use that algorithm used in mortgage lending. And from there, it creates your AI action plan. So that's going to tell you what's the most impactful things to raising your credit score. And as you complete each step, they're marked off as complete, and the next most impactful things are replaced. You can change your goals. You can rerun this report as many times as you want. It's automatically going to generate an updated plan every time you get a new credit report imported, which is once a month. So once per month, you have a new credit report. Every 40 days, the system's going to automatically import it. It wants to give enough time for those credit bureaus to receive your disputes, okay? So if you are disputing something, it will automatically import your report at 40 days. The action plan is also going to recommend those credit building tools we mentioned at the beginning. So if there are things where you're not influencing the algorithm where you could be, if there's opportunities outside of what's already on your report, then we're going to tell you, right? The system's going to tell you. It's going to recommend what makes the most sense. It doesn't want you doing things that aren't going to move the needle on improving your credit scores. Did I forget anything about that part? Okay. Last, and then I promise I will hurry up. Financial literacy. Okay, we're all here to learn, right? We talked in the very beginning, none of us get education on credit and how it works. So why don't we solve that? So now you can monitor your credit, you can get identity theft protection, clear your info from the dark web, you can dispute negative information that's incorrect, obsolete, or inaccurate. I said inaccurate twice, inconsistent. You can figure out how to get and maintain the perfect scores, and you can figure out everything you need to know about credit. And that's through that credit coaching section where we have a whole bunch of different classes on credit. So it's broken down into 7 different categories. Each video ranges from about 5 minutes to 10 minutes. The only section where that is not the case is the section on how to read a credit report, section 4. Those are longer videos. It's a lot more in depth. But each section builds off your understanding of the last. You can take videos in any order you want. I suggest starting at the beginning, but completely up to you.
What a great resource for, professionals even.
Mhm.
You don't have to be the person who has the credit issue.
Exactly.
Be the professional who can go on here and get that information for the financial literacy. Again, like I said before, be that true trusted advisor. And the cool thing is like Ivory said, you could go down the course in order, or you can cherry pick. So if a client has a specific question about credit, you can go on there and find the course that might give you the answer. So it's
Yeah.
pretty amazing for that resource as well.
Yeah. Or you can tell them, go watch this video. It'll give you the answers.
Exactly.
Let's watch it together. So, I know we went long. We have a bad habit of doing that. But if you want to learn more, you want to check out the software, you can go to creditscorepro.ai. We have, like I said, the credit building out there, but obviously we suggest using the AI to tell you which building makes the most sense for you. If you have questions, there's our email. We also have a Facebook group, Credit Score Pro, the AI Credit Revolution. Feel free to join us on there. And then we do
Lots
have
of professionals on that page because
yeah,
you get consumers on that page that have questions that are even outside of the credit space that maybe have to do with real estate or lending. And we need more professionals on there that be able to answer those questions as well.
the last thing I'll mention too is as a professional, if you do want to be an affiliate with us, there is the option to have your clients use the platform where you can be updated on what's going on with that client as they're working on their credit too. So there is a window into what they are doing. That way, the whole point is let's help you help them. So with that, we can leave it to a Q&A if anyone wants to ask. I don't think we have I was just speeding through things, so I wasn't paying too much attention to questions.
I'm
We're already 15 minutes over, so.
Yeah. I'm good. Rex, did you have any questions since you're on the Zoom with us? You good? No questions. Awesome. Well,
Okay.
we appreciate everyone who's watched this video. Rex, we appreciate you for being here with us today. And we're excited about doing these webinars. We will not be here next week. So if you try to come see us, we won't be here. We will be at a credit conference. We do that every year. And that's where we learn more about the industry, and we will bring that back to you the following week when we get back. So appreciate you again. Have a wonderful weekend and next week, and we'll talk to you in weeks.
I'll just plug the next event. Next event, May 9th, 2 p.m. Pacific, 5 p.m. Eastern, Navigating Credit Myths, Essential Knowledge. Oh God, I'm so large in the screen. So the next one is all focused on myths. So anyway, we'll see you there.
All right, see you later.
Bye guys.